What is going on, guys? Today we have a very exciting video for you, and it's really the talk of the town right now because it's the first earnings announced, the first major earnings announced for this earnings season, and that is Netflix stock. And Netflix stock has plummeted here recently, and today we're going to go over basically why it plummeted. We're going to take a look at the stock, we're going to take a look at its valuation, and then we're going to take a look at where we think the valuation needs to go for people to really start adding it to their portfolio and adding it very heavy. So overall, we're going to just do a quick analysis on Netflix, and if you enjoy the video, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit that sub button. So first, we're going to take a look at Netflix's chart, and what we can see is over the last day, they're down 35.12%. After hours, they're down even more, so they're down another $3 after hours today. And that's 1.42%. And all of this comes on the back of their most recent earnings announcement. So yesterday, after hours, they announced earnings, and the stock went from around 350 all the way down, you can see, to under 250, around 220, and kind of stabilized there for the day. Basically stabilized off there. They actually opened around 250 and then stabilized, around the 220 mark. So we're gonna have to see if this stock continues to drop on this news, but overall, for a day following, they really stabilized off and kind of had a lot of stability around this 220. So it'll be interesting to see over the next week if the stock continues to fall, kind of what happens with it. If I had to guess, it would continue to fall with all the macroeconomic events going on. Basically, wouldn't be surprised to see it fall even further, and we're going to take a look here in a second at where we would like to see it fall to start adding it to our portfolio. So what's surprising on the back of earnings, right? They announced earnings April 19th, so yesterday after hours, and they actually had a 20% beat on EPS, which is insane. That's a very, very high number. So they expected earnings per share of $2.92, and they actually reported $3.53, which equated to, like I said, almost 21% beat. Revenue, however, they were down barely, almost a percent, just a little less than percent. So they expected 7.94 billion and reported 7.87 billion. So let's get into actually why this revenue number kind of matters and how it kind of affects the overall growth prospects of Netflix. So here I picked an article by CNBC, and basically they're just going over some of the topics that were discussed during the earnings call, and the biggest one being right here that Netflix lost subscribers for the first time in more than a decade. So Netflix has always been a growth company, and that growth has came on the back of subscriber growth. And with them losing subscribers, this kind of changes the perspective of the company of whether it's still a growth company or is it more of a value play at this point. And obviously they have a lot more competitors in the market. You have Disney Plus, you have Hulu, you have HBO, you have all these other competitors that are getting into the market and overall affecting their subscriber growth and their numbers all around. So really it's very interesting that they've lost subscribers for the first time in more than a decade. It's kind of pointing to things changing, and what Netflix is doing is the right thing. So they're talking about how can they change their platform, and what they talk about here is basically adding, or the potential of adding, a lower tier option to their subscription basis that would be, they're not saying necessarily whether it would be free or whether it would be at a small charge, but basically I would assume compared to kind of some of these other platforms that it would most likely be free, and they would run ads on that platform or on that account, against that account, that would make up for their them running you having a free subscription. So what they're really looking to do is target basically consumers, like they talk about here, that are more price conscious. So people who don't necessarily want to pay the inflated fee. I mean, the other factor that's all running into this is they've upped their fees for the first time in a couple of years. They do it every couple of years, and there's always pushback when they do it. But this is obviously the first time that they've had a loss in subscribers over that time period. So what's interesting is that they're increasing their fees, and it comes at a time when everything is increasing. So people naturally they're going to cut things that they're able to cut. And one of those things is Netflix. It's not like they can cut their food. It's not like they can cut their gas. They have to go to work. They have to buy food to eat. There's necessities like that they really can't cut down pricing on. So consumers are looking at luxuries, things that are kind of more nice to haves like Netflix, and saying that It's not really something that they have to have at this time. And they're targeting and trying to do something that's similar to Hulu and Disney and HBO. But I would not be surprised if some of these other platforms, they are younger, so they are more likely to have more growth, Hulu, Disney, and HBO. But I wouldn't be surprised if over this earnings period they announce some interesting numbers in terms of their subscriber growth as well, because as we're getting out of the pandemic and everything, a lot of people are spending less time at home, and there's less need to have so many services. So people look at their array of services, whether they have Hulu, Disney, HBO, and maybe even all the streaming services, and they might say, this is the one I use the least and this is the one I'm going to cut. And that might have been Netflix for some people, but I wouldn't be surprised, if that's HBO or Hulu or Disney for other people. So as that kind of changes, it'll be interesting to actually see how these numbers come out, especially Hulu and HBO. Disney has a little bit, they're a little more diversified, where you won't necessarily see their number as clearly in their revenue and their EPS, but it'll be interesting to listen to the conference calls and actually get that feedback. So now let's jump into basically where the valuation's at and where we would like to see it go for a lot more value investors to get into the stock. All right, so here we are looking at something that I've done before with other stocks, and normally what I'm doing is I'm using the PE ratio to predict future price based off what the potential PE ratio is, the potential forward, the average forward PE. What we're doing here is we're going to say what we would like to purchase Netflix at for PE ratio. So if we're comfortable purchasing Netflix at a 20 PE ratio, 25 PE ratio, 15 PE ratio, basically we can use that number and backtrack to what price would we be comfortable getting into Netflix at, because it will be at that PE ratio, again assuming earnings and other things don't occur that drive earnings down, because obviously earnings is the other effect that we'll have on PE ratio. But right now earnings look very strong for Netflix, so there's no real concern there. So what we're going to do is we're going to look at two scenarios here. So we have one where the PE ratio goes down to 20, and we have one where the PE ratio goes down to 25. And let me jump back real quick. So the current PE ratio is 31.85, and the current price is 226, or around there. Basically, that's kind of unimportant. A couple dollars here there is not going to make a huge difference, and we're just pulling that from here. So 226, and then we have the forward PE ratio of 31.85. So we could update to after hours pricing, but when it opens in the morning, it could be vastly different, and when you watch this video, it could be vastly different. So it's just to give you an idea, and you can kind of move the price around, and I'll show you kind of the math behind this. So if we wait until the stock drops to a 20 PE ratio, we are going to need a price of $142 about. So that would be, a fairly significant drop. We're looking at around 30%, 30 to 40%. And really, how realistic is that to happen? I don't know for sure. And a 20 PE ratio would be a very good deal, in my opinion, for Netflix, because I do think there's a little bit of growth, still going forward. And I think they can expand and take on. And then they would also, in my opinion, Netflix has always kind of been a buyout opportunity, but they never really sold. So if Apple TV or some of these other big companies, Amazon, ever end up wanting to get rid of their service but still want to stay in the streaming game, I could see them trying to acquire someone like Netflix or similar, who already has the subscriber base. So kind of would be interesting to be able to acquire the stock down this low. But yeah, that's kind of a price that I would actually be more interested in, is 141 compared to them where it's at today. But if we were to only wait until it goes down to a 25 PE ratio, we would only have to wait until the stock goes down to 177. I don't think this is out of the realm of possibility. I think 177, if things especially get worse on the global economic scale, I could see the stock dropping down this low and potentially, picking up a few shares. Right now, I've built out a lot of my positions into where I'm very comfortable with, and I don't really see the need or want to add another position in. And that, there's a lot better stocks out there that I think are even further, have greater upside potentials than Netflix, but I still think it's interesting. to kind of see where the price would have to go for it to get into, value investor territory. And one more thing that would be very interesting, a lot of value investors look for even 15 PE ratios. So if we go down all the way to 15, you would have to be at almost $100. And realistically, is that going to happen? I mean, it'd have to drop another over 50% for it to get down there. So I think that's kind of unrealistic. I could see it dropping to a 25 PE ratio and finding stability there. But I think a lot of their numbers and things that they're doing moving forward with having a lower priced option, potentially, throwing ads on there, I think overall that's going to boost the business and, attract new subscribers, people who, don't want to pay as much or want a free service and, get their subscriber base back up. And I think it's just kind of an overblown reaction from Netflix becoming less of a growth company because they don't have the user base growth. So overall, not super interested in Netflix, but I think it's interesting to look at. I don't own any shares, just full transparency, but I do hope you enjoyed the video, and if you did, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit that sub button. Otherwise, have a wonderful rest of your day.